Welcome, guys. Welcome to the third track of fourth season of Upskill Club. This will be a course, basically, and this track will focus on finance for professionals. What do we mean by finance for professionals? Oftentimes, what happens is, even though while we are, let's say, building our careers, we forget to build our finances, and that is a fundamental mistake people do because what I believe is getting to a certain point in life through your own hard work. What do I mean by that? Having a decent salary does takes effort, and whatever amount that you accumulate through that is good, but sustaining that is hard because of survivorship bias or simply inflation. So the onus is actually on you, me, and everybody else to understand the basic of finances, especially personal finance, so that you can understand how to take care of your money, and so that money can take care of you. And with that, I hand over the course to Himanshu. Himanshu is one of my dear friend. I have known him for more than 4 years. You guys have known him for more than, let's say, a couple of years at least in individual capacity. He personally brings a little bit of paranoia and about finances. He's particularly very finicky in terms of if anything goes ups and down. So that is the trait that he has. That's why he likes finance. Also, what he likes to indulge in is reading about a lot of financial options that they are available. It's okay to only read about them, actually to identify them to and take risk in them ahead of time is another level, and then to track and communicate the same is the third level. So luckily Himanshu has reached the third level. That is what he will share with all of you guys over the course of this track. This track will be incremental in nature. If you are part of the first session, we sincerely hope that you will be part of the next sessions, because we'll continuously build on top of the previous knowledge. So will prevent you whenever you try to jump in the future and say कि, hey ये ऐसे कैसे होता है, ये आगे मतलब ये कैसे होगा, will prevent you there. And you guys need to trust us कि in the upcoming session we'll take care of the session, in the upcoming session those questions. What we want us, me and Himanshu, from this session is, after this track is over, you personally are able to take care of your finances, understand the nuances of all the investment opportunities that are there, and create a plan for yourself without anybody's interference, which best suits you based upon either whatever type of investor you are. Fair enough. With that, Himanshu, over to you. Let us all financially upscale.
Yeah, thanks, Anupam. So before we start, I'd like to give you some of the introduction of how I came into this and how I started thinking about it. So basically, I made my first investment in 2006. I passed out in 2016. So 2016, I started earning, right? And it was late 2016 when I started investing. So first thing I came to mind was that, okay, I'm earning some money. That money is going in bank, but is that money resourceful to me, right? Is it making my life easier in future, or is it just staying there?
Himanshu, you continue. Sorry, I'll just indulge the audience.
Yeah, so that was my thinking when I started it, right? Then it's obviously you won't know anything from day one, and you won't know anything ever 100%. So eventually, with some friends like Anupam and other, I came in. I was introduced to stock market, right? Before stock market, I was aware of. I tried crypto also, so that is different point of view. But then there are multiple. Then I understood that stock market is just one of the form of investment. There are multiple, and we'll talk about them in detail throughout the series. But yeah, so let's start by introducing ourselves when we started investment and why do we think, like as Anupam has asked, right? What was your first investment and why do you think investment is necessary? Just a quick short answer.
We can go around the table because you can start.
Yeah.
So actually, I was never interested in investing, but lots of folks in family, brothers, sister, cousins, has like they forced me to invest. So I looked at the easiest possible option, and also since I didn't have that discipline of transferring or making investment every month, I have initiated a auto debit sort of a system with Grow. So it debits everything, like basically a specific amount at the starting of the month, and that is basically continue. That is the only thing that I have as of now. Also, I don't really know So basically, I have invested in like 7 or 8 SIPs, but I don't really know which one are they and like what are they doing exactly.
And
Basically, some
what was your decision of choosing? Like, how did you choose which mutual fund to invest?
I didn't
Right.
do it. Somebody else chose that for me. They
Okay.
So I decided, okay, this is the amount I can invest, and they basically said, okay, just create an account in Grow or somewhere, and then these are the SIP that you have to invest in. I don't really understand anything, like anything at
Cool.
all.
Then I think today's session will be helpful to you.
Cool. I'll
Yeah.
go next. So, I guess after I started on the job, first year was mainly my money drained down the parties. So I was working in Noida in Mentor Graphics, and most of my friends were in Gurgaon. Every weekend I used to be in Sector 29, and that's where all my money went. But then after a year, when my father actually looked at the passbook, then, then and then when he pushed me कि नहीं ऐसे तो नहीं चलेगा, you actually have to have some investment. Then I started looking onto it. So as generally parents do, the form of investment like FDs or PPF account, that was my first you can say first form of investment. Then in my company itself, people were a little bit familiar with the mutual funds. This is year 2016, but most of people in my company at least were into real estate. Matlab, they were very very much into real estate, and I also started planning around it. But I knew कि real estate needed a very very heavy investment, and that's why I went wrong. What I started doing is कि I just looked out कि what are the options where I can get more interest like FDs or something like that. I started pushing my savings, more and more savings into that, so that I can build a big corpus and then invest into the real estate. So that's how my journey started. And I mostly stayed away from crypto. I never liked crypto because my uh, my opinion was always like ki, there's no physical product or something binding to it. How is it governing ups and down? I also didn't went down in the details, but I never liked the concept of the cryptocurrency and always thought it very risky. So I stayed away from crypto. I guess 2019 when I started company, well, discussing with friends, and then I also invested in some of the tax saving funds and equity funds. So that's been
Mhm.
pretty much my journey.
Nice. What about, let's ask Aman if I think his journey, he's pretty
हाँ
starting his career phase.
हाँ तो go ahead,
So,
Aman.
so actually, my family has a very preservative nature. So they believe on preserving money in the bank, not in the playing in a stock market. So because they had a lack of knowledge. My father don't have a too much, you can say, expertise, right, or the market depth. He didn't know. But when I joined UC and there were a couple of my folks were start investing, so I also starting a little bit of investing in some Tata Motors because EV sector was booming. But yeah, that the lack of knowledge, I didn't have any lack of knowledge. I just go with the flow. Every day it goes up and down. I just check on Google you 6 months stock before 1 year stock, what's the price and what's the now. So it just gave me intuition. I invested and I realized that yeah, that's not a good way and didn't fruitful for me as well. And the Russian war goes as well goes. I think over that time the stock market stopped. So that why I think yes, you have some knowledge always to go into any of the segments. So yeah, that's why I realized that it's not the right way. And most of the people do this. I have just realized most of the people just see the Google chart history, 6 months stock and saying this is see the graph. Oh, graph was have a good exponential and they will start investing, but they realize yeah, that's not a good way.
Mature statement from you, Aman. I often realize this a little bit later, but it's good that you have realized the same very soon. Cool.
Thanks.
Last is
Thanks.
Mukul. Last is Mukul.
Yeah.
So my first investment was in like college time only, like during the third year after the interns. I saved a good amount of money and did FDs in that because I knew FDs at that particular point of time. And after graduating from like 2018, then my brother has done the research of mutual fund, and I trusted him and I invested in them, in those mutual funds, and till time I invest in those mutual funds. So that was my like first part of the investments. Yeah.
Okay, I guess Himanshu, I will be last. Funny enough, I started my investment journey more than 2 or 3 years after, let's say, earning money. I gave my money to be managed by somebody else. I made an investment of 25,000. I did that to there is a special the special exemption that used to happen in last tax bracket was 80 ccg or something like that, Rajiv Gandhi stock market investment. It is more about if you invest in the stock market for the first time and the amount is 25,000, you get that is the non-taxable then. So that is the reason I invested, and I invested 25,000 in margin trading and I lost 35,000. Uh, so that was a very very strong trigger for me कि I invested 25,000, why do I have to pay 35,000? I'm just not able to fathom the concept. Then I made a motto कि I need to understand this. I'll not invest anywhere any single time until unless I understand it really well. So that loss of 35,000 has actually luckily quadrupled a decent amount of let's say times, but that was the reason I started to learn and go deep in finance. I guess
Yeah.
that's a good introduction by all of us about our journey. Himanshu will take over now, Himanshu, and then today
Yeah.
we'll cover mutual funds, I guess, right, Himanshu?
Yeah. Yes.
Himanshu,
But
over.
before going to mutual funds, I have one more question that I think everybody of us who want to be aware should know. Why do we want to earn more interest on money, right? We can put it in a bank, have a 2.5%, or some risky banks will give you 5 or 7% also rate of interest, right? And then there are FDs, then there are long-term FDs, you'll put it tax saving FDs, and you can get some interest out of it. But what is the need to earn more? What is
So
the fundamental reason of investment? Yes.
so basically, yeah, there's a concept of inflation. Okay. Uh, when like for example, 1 lakh is your in your account. That 1 lakh is worth 1 lakh after 5 years as well. Okay, same 1 lakh amount. Reason being, FD gives that much interest just to cover that inflation part. It's not earning you anything on the top of it. Okay, so that one particular case is like these mutual funds give 10 to 12%, so at least 3 to 5% more money that you can earn on the top of it. So that's why we want to earn more through mutual fund or any other source.
Yeah. I'll like just to summarize it a little better. Uh, every inflation, everybody understands inflation. Inflation is actually that how much expensive a set of goods or services have become over a certain period of time in a country or somewhere, right? So it's a price index and we all follow it. So in 2018 it was 3.9% in India, and in 2022 it is 6.7%, right now. We know we have an economic slowdown, but inflation is high. But yeah, last year it was 5.1. Before that, due to COVID, it was 6.6. So you see this percentage, it's more than FD. It's more than bank interest. Good banks are giving 2.5, 3%, 3.5, right? There is a range, but we need to understand that we have, like Mukul said, we have 1 lakh rupees in an account, right? And today, let's say for 1 lakh rupees, we can buy X amount of goods that are good enough for our monthly budget, right? Next month, let's say the inflation is 6 to 7%, and after some time now, you know that your earning is 2.5% on it. You'll just increase by 1 lakh and 2,500 will come to your pocket, but you can't make your same expensive what amount you were going to buy last month, right? So you need to beat that. So your first basic target has to be to beat inflation. It does not has to be to earn more than 2%, 3%, 5%, right? And the more we earn, it's better. The more we earn, that is will later. But the main concept over here is that we want to beat inflation so that the money in our account, the value of the money in our account increases with, right? Makes sense. So there are different ways in which we can invest money. So should I share screen, Anupam, or
You can go ahead.
is it visible?
Yeah. I guess we need to zoom it a bit. That was one of the feedback people gave us in our early
Sure,
session.
I'll do that.
We need to
I'll do
just press command plus plus. A bit more, I guess.
This is the max I can go.
Okay.
Oh, it works.
This,
Just with a
this,
minor
this
delay.
is
this will be
this
the
is
best.
This is better?
This will be the best.
Yeah.
hmm.
So before we move to mutual funds, what I would like to do is I would like to go and share some time on what are the different mode in which a retail investor can invest money. And these are some with time, everywhere the opportunity that was within it. First, let's talk. Do you know that we guys are retail investors or institutional investor? What's the difference between these two words? You'll heard it everywhere in the documents. Anyone?
Hmm. No.
Okay. So basically, retail investors are investors such as us that are investing in their individual capacity, right? And mostly when an institution or an organization is investing in money, they're mostly called institutional investor, right? Then in retail investors are there, and then there are high net worth investors. So basically, let's say your net worth is above a threshold, then country can consider you as a high net worth investor. So there will be some modes that will be open for you that are not open for retail investors. The reason is we don't want retail investors to invest money, so much money, and lose it that they are not able to recover. So in India, we have a very good ecosystem where the organization is trying to protect us from losing money. So that will always help you understand. Yeah. So now let's talk about retail investors. So first one is very common one, right? Bank savings and FD. Everybody understands. Second is stocks, right? Do you understand what are stocks actually? Anyone would like to take?
It's actually exactly what you have written in the doc. Each stock actually represents some part of investment in the physical or assets of the company basically. So
Cool.
that's it.
Yeah. So equity market, stock market, everybody might be using Zerodha, Grow and all this to invest over here, right? Then there's something called bonds. Bonds is a very interesting concept. So basically, it's a loan made by an investor to a borrower, right? So basically, Pranav can come up tomorrow and say, I want 100 rupees. I'll give you 10% rate of interest. Can you give me 100 rupees? I'll give him 100 rupees, and we have signed a bond that he'll give me 110 rupees on a particular fixed date, right? And now this can be one time, like he can give me directly 110 rupees, or over a time it can be divided into installments, in which installments he'll give it to me, right? Now these bonds are issued by government as well as some private institutions and companies, right? We'll go in detail later when we talk about bonds. Right now, just this is the basics. Now the fourth one that I think everybody of this is the most common, mutual fund sahi hai, right? We have heard it, mutual fund sahi hai. Sachin doing an ad, Dhoni doing an ad, everybody have heard it, right? So what is mutual fund? Basically, it's a basket. It's a basket for diversification that a particular fund manager has created for you. Like Vikas said, right? He does not understand what stocks to buy, right? We don't. So stocks, it's very tricky to understand what I should buy because you need to be very active, and it's a proactive approach. It cannot happen later. So you need to go and read about the financials of the company. You need to understand on the jargons of the economy. You need to understand how the profitability is. But then there are some companies that come up and say, okay, it's very difficult for you to do it. We'll do it for you, and we'll make sure that you earn a fixed percentage, and we'll also manage the risk, right? We'll go in details how these funds comes up and what are different types of risk and what are different type of mutual fund. But for now, you can understand it's like multiple investors come together, right, to purchase a diverse portfolio. Okay, next one is ETFs. Now, this is also a very interesting concept. People usually confuse between mutual fund and ETFs. But it is also a basket. It is also diversification. But these are passively managed. So what was mutual fund? Mutual fund has a fund manager who's actively managing, taking decisions. I'll change the ratio and I'll change the stock. But ETFs are like passively managed, right? So passively managed means they can be an algorithm or they can just be a representation of some fixed like Nifty 50, right? Top Nifty 50 stocks. It's just tracking top 50 stocks, Nifty stocks. And why do we need mutual fund and ETFs to diversify? This is also a very interesting thing. So let's say there is a top Nifty 50 stocks you want to buy and you want to always invest in top Nifty 50 stocks. The amount that every individual here wants to invest depends upon his capacity to invest, right? Buying all one stock for all 50 stocks, not possible. Very costly, right? Everybody will not have the budget to buy it. So buying fractional is not that popular in India and like in different markets it is. So it says that we all together can buy a ETF and our money combined will be used to buy a Nifty 50, and then Nifty 50 ETF will break into smaller units and we'll buy those smaller units. But together we are buying those, right? So that's like mutual funds concept. Like together everyone is buying ETFs together everyone. Another one is real estate investment trusts, right? So this is REITs. This is a this is an old concept. I won't say it's a new concept, but it has gained popularity over last few years, right? So basically, there are properties. Big Mindspace is a builder, Embassy, DLF, right? They have big properties, apartments, office complex. They give it on rent, right? And they say we'll share this rent. So whosoever is owning a share in that REIT, right? So they'll start a REIT for it. Everybody can buy the units and they'll share the rents with you. Now, government has mandated that this can only happen if you share X% to your investors. So let's say I have a house and let's say I'm getting a rent of 10,000, right? Now I say everybody of you can buy some unit of it and I'll share the rent among myself. But I'm getting 10,000 rupees rent. I can say, no, I'm using this 10,000 in building something else or something like that, right? But over here, you cannot. You have to share. That is a compulsion by the government. That's why these are interesting. Like they'll give you around 6 to 7%. Invoice discounting, again, a new, very new concept, I would say, like very new concept. Let's say tomorrow, I want, I, as a small company, got an order from Coca-Cola to build their bottles, right? And I don't have enough money to fulfill that order. What I'll do? Earlier times, I'll go to market, I'll take loan from someone, right, and give him some rate of interest. And using that loan, I'll fulfill that order, get money from the Coca-Cola, and return the money with interest to everyone else. This is the whole concept over there, right? But now going to market means now this is accessible to retail investors. So there are sites that allow retail investors to give this money on a fixed rate of interest and get it at a fixed date back. Okay, so that is invoice discounting. So the bill has already been generated. The company already has an order. They already have a purchase order for buying something. P2P lending is, let's say, Vikas needs some money. Aman gives him some money on some rate of interest, and they do it via app. And there is no bank involved in it. Now this rate of interest can be anything. Cheese ops, everybody knows company has an option to give, like some companies are not public, they don't have shares. So they create share option plan that they'll give you shares. So some companies allow us to buy that. Some give you when you invest some time on the company. NCD is a very interesting concept. It's also similar to, I'll say, you give some money, you lend the money to a company at a fixed rate of interest. You don't have to think about it, right? Company will give you that money, like it can be quarterly, monthly, and all this. So these are some of the top concepts that are possible. There are more like real estate and all, yeah, but I've started with some top one like right now. Is this clear? Like we'll go to mutual fund now in depth for the first session. Do you have anything to ask or something?
Yeah, I guess there's a small difference between invoice discounting and P2P lending, because earlier I was thinking it's the same. In invoice discounting, prerequisite is key that the company already has that bill. It has the solid proof of purchase order,
Yes.
whereas P2P lending is mostly on trust. It's like a verbal contract or some contract that you are lending with this much money and I will give you this much interest.
Contract can be written. The concept here is you are not sure what the other person will do of that money. You
Will
only
do,
care about
yeah.
will get that back the money in this rate of interest. Yeah, so that is the concept. And over here, institutions are less. It's more about people doing it. Okay?
Cool.
Himanshu, can you talk a bit about RD and FD?
So fixed deposits, right, and RD. I think FD is mostly RD was before, right? Like recurring deposits. It's mostly recurring deposits, right? And FD is fixed deposit. You fix an amount. FD can also have now option to reinvest your principal in money. So it's
Yeah.
almost similar.
Okay.
I
So
think that
just an example, Vikas. So what happens is like you have 10,000. Okay.
Yes.
So let's take an example of 12,000 actually. So what you can do is you can invest 1,000 as a recurring deposit monthly, or what you can do is you can have an FD of 12,000. Okay. Interest rates are almost similar. RD generally tends to have a little higher interest. Uh, but in the end, what happens is RD में तो वो ऑटो अपने आप चलता रहता है, हर महीने चलता रहता है. FD में क्या होता है कि you have option at the end of the year when 12,000 has become something like 12,500, you can reinvest whole value uh, in the next FD. So eventually, it seems like it has a simple interest, but it's actually compounding. It's actually compounding on the principal that you have calculated in 1 year.
You can say RD is an SIP of FD.
Yeah.
So FD is something like it's mostly you said 10,000 मैंने इस FD में डाल दिया, ये fixed deposit है मेरा अगले 5 साल के लिए. In RD you will say after regular interval I'll start putting 10,000. It's at regular interval it will take you 10,000, right? And after let's say you have 5 in a tenor and you say I'll invest 10,000 quarterly. So for 5 year, every quarter you'll invest 10,000, but after 5 year, what you will get back is the complete principal and the interest that you have earned on that money. But in FD, you have invested 10,000 and you will get the interest as well as 10,000 after 5 year. You can create a new FD, but you cannot put more money in the same FD. Is this making sense?
Okay. And who I give this money to? Like who
Bank,
offers me
bank,
FDs
bank.
and
Banks.
sorry,
Bank.
bank only.
Bank, say.
And post office also?
Yeah, post
Yeah,
office has a
yeah.
scheme. The post office has many different schemes. We'll discuss them sometime else, but post office they have a very different government organized scheme. But we'll go in that after. We'll take a session on that once.
Sure.
One thing, Himanshu, I guess there's another way of I don't know what you will say, but one way of investment I recently actually started looking onto it. So many banks and insurance sector, they also provide you schemes wherein you put in some money, okay, and they give you guaranteed return. So that is the keyword here, the guaranteed return. Okay.
Are you
And in
talking
some
about ULIPs? I think something like that, right?
something like that. Yeah, something like ULIPs. Yeah.
Yeah, I think
So
we'll take those in some sessions.
okay, okay. Got it. Got it.
Cool. So now let's go in detail in mutual funds. The idea over here is like Vikas very well pointed out, right? He invests in mutual funds, but he does not understand them, right? Our whole aim today is to understand a mutual fund. What is a mutual fund? What are different types of mutual fund? What are different terminologies in mutual fund, right? So let's keep it a very two-way session and start, right? Do you understand what are different types of mutual funds? It's well written over there, but yeah, who all understand it and who all like don't understand and just invest? Yeah.
I actually don't know much difference between, but I know it very subtly between
Okay.
equity, debt, and those funds. Tax saving funds are also there. So yeah, little bit about them, but not in deep.
Okay. So if you see, I have added some images, right? These I have taken it from Coin. So yeah, the credit goes to Zerodha. So these are some of the mutual funds. In every mutual fund, there is a small terminology that they try to mention it. Growth, depth, guilt, growth, depth, liquid, right? AUM, IDCW in terms. Too many terminologies over here to understand what to buy, right? But the core concept of mutual fund is that I want to earn return. Why do I need to understand all these concepts, right? These are important for you to understand a fund before you invest money, right? You have an expectation from a fund that will give me a percentage of return, but on what basis are you keeping that expectation? That is very important for, right? So an equity fund says that I'm investing most of my money in stock market. right? Buying shares. That is an equity fund. The growth the growth over here mentions, right, that whatever money I'll earn as a return or as a dividend from the money that I've invested, I'll reinvest. So every time you buy a stock, right, you get some dividends when a company shares the profits with their holders, right? So it will say I'll reinvest it. And this guilt actually means that this one, oh, sorry, let's go to equity only for now. This one, right? And the AUM, can anyone tell me what is an AUM? This mentions 34,194 crore, right? So it's actually telling the fund managing how much big the fund is. It's a representation of that, right? So you need to understand this, that AUM is assets under management, right? So this tell you what is the volume of asset that is under management. Very important to understand it, right? That you are investing in something, what is the volume of asset that is managed by this fund. So this is one type of fund. So we have discussed equity. We understood what growth meant, right? We understood what AUM meant. Now we need to see that over here it is mentioned something called debt. Can anybody would like to take a hit what debt means? Like why? How is it different from equity? Everybody, I hope, is investing some money in a mutual fund for any purpose. Like they might be doing it for just tax saving purposes or anything. So why we need to understand this, right? What debt is. It is also an instrument of investment, right? Like shares, but it is not in equity market. It's more on bonds, treasury bills, right? So what is the difference over here is these are little less risky as compared to equity, right? The return is less, but the risk is also less. So these are different instruments in which the money is going. So a fund manager chooses what type of instruments he wants to invest his money in, right? So these tell you this fund is in which type of instrument is this fund investing money. It might also be investing over it. There might be a fund that say I invest in both, right? Equity and debt to balance. But that is very important for us to understand. So that is this. So let's go to another terminology which I mentioned: income distribution come capital withdrawal. This is the full form of IDCW. Income distribution come capital withdrawal, right? So very complicated full form, but what over here it means is it instead of in growth, what was happening? Your money was getting reinvested, right? But it is saying I'll distribute some money internally. It can be quarterly, monthly, or 6 monthly, yearly to my holders, right? I'll give them some money and I'll give the option to also withdraw some part of money. Okay. So your dividend might come back to you rather than getting reinvested. So it depends on you which one to choose. And we'll also decide how, we'll also come up in how to think which one I want to, what is the right way to think which mutual fund to choose. Okay. Then come funds of funds. Very interesting concept. Like you said, we have mutual fund, that was for diversification. Right. Now you are saying we have funds of funds. Fund of funds saying that inside I have many funds. So inside me there is a diversification already. I myself represent diversification, but inside me the instruments also represent diversification. So this point is like he said, Vikas, that he invested in some 5 mutual funds, right? Now he don't know anything about those 5 mutual funds. So there might be a fund manager who comes and say, okay, I'll invest in funds. I'll choose 5 funds for you. And I'll keep on changing on the basis of what needs to be balanced and how it should be balanced. So now you need to invest in only one fund. That is itself investing in multiple funds. It's his responsibility to make sure in which fund I should invest. Okay. So these are different 3 types of funds. There are so many more terminologies that we need to understand, right? Whenever we buy a mutual fund, we see something written as current NAV.
Yeah.
Right. What do we understand with this current NAV?
Current value, actually, net asset value. That's what it stands for.
Nice. So what decision, when does this NAV change?
I guess it changes every day, just like stock market.
Yes, daily. So a NAV is fixed for a day almost. It changes in between day, but mostly it is fixed, right? So it is net asset value. So how is it calculated? This is the formula. So every mutual fund or funds have an assets, but they also have some liabilities. So they mind asset minus liability divided by number of share is actually the formula for calculating the NAV. This is the base this is the value that you understand and buy, right? Less NAV, you try to invest more. That is the concept. It's equivalent to VM, right? सस्ता मिल रहा extra ले लो, महंगा मिल रहा मैं एक खरीदूंगा, right? But the representation over is asset. If it's costly also, it might be the different reason why it's costly, right? There might be the reason number of shares that are in circulation are less, so NAV can be high, right? The similar concept is a company share can be of 3 lakh rupees and company share can be of 300 rupees, but the overall evaluation can be same because it also depends upon the number of shares that are in circulation. So this is another one. Now when we see NAV, after this there is this terminology CAGR. We know simple interest, we know compound interest, and again we see another term called CAGR. And this is the only term that you will mostly see everywhere before deciding which mutual fund you want to buy. Anyone you want to take a guess at what this represents? These are all mathematical formulas, actually.
So CAGR is, so let's say I'll take an example. If a mutual fund is there and it has returned 10% in 1 year, 20%.
Sorry for the interruption. We'll resume from CAGR. Himanshu, over to you.
Screen visible है? कौन सी
Yes.
screen visible है? Yeah. So correct screen visible, I hope.
Yep.
So Manish was telling something about CAGR.
Yeah, so I was saying, let's say if you invest in any instrument and it gives you 10% return you invest 100 rupees, it gives you 10% return, it becomes 110, then 20% return in the next year and 30% in the next year. Overall, let's say you'll end up making 139 rupees. Now, because it's very hard to remember all these numbers over the period of time, one simple value, a compound interest number that you would want to know is what is a percentage return every year? If I would have gotten a flat return every year, how would I reach 140 rupees from 100 rupees in 3 years? And that number would come out to be 11%.
Exactly. So
11% would be CAGR. Yeah.
Yep. So exactly what Manish mentioned. So you have an end value, you have a start value, and you want to understand, right? Because you invest over a long period of time or a small period of time. Now that period can be different for everyone, and actually the rate of interest can be different in every year. Overall average interest rate every year. So they come up with a new number. This is called compound annual growth rate, and this compound annual growth rate represents like the earning, and the formula is straightforward. They just take your start time, they take the end value, they minus both, and then it's one by a number of years minus one. So I've given an example over here for making sense. So now we understand what CAGR is also representing, right? Now we understand what a NAV is also.
Himanshu, this is compounded, not simple interest. It's like not principal minus final value. Final value minus principal over.
In simple interest, compound interest does not matter. They are ways of your return that you're getting a simple interest or a compound interest or something, right? This is also a simple metrics, similar metrics, I would say, that says how much your money would have changed over a period of time by calculating it from the end and the start. That's it. Okay. So let's say 1% CAGR, 1 year is simple, but for 5 year it will be how much money might have grown every year, so that you would have reached to a particular number. Like if 5%, it would have grown 5% every year, right? So that is what it is. Now, minimum investment, everybody understands. AUM, we have already discussed about. These two are pretty interesting things. Exit load and expense ratio. First question will be, how many of you, before investing into a mutual fund, check for exit load and expense ratio?
I check every time.
One.
I check.
So yeah, let's start with one of you just discussing what these are. Anyone?
Okay, I'll take a stab. So expense ratio is simply kharcha pani. It's actually the ratio of your profit that is kept by the fund manager house or whatever organization that is managing that fund. So that is the expense ratio. Exit load is a kind of a penalty that is levied on you if you exit the fund before the minimum year of investment. I guess I'm not very clear. Is it fully goes towards paying tax to the government, or is just that the penalty goes to the fund managing house? That is, I'm not clear, but yeah, this is kind of a penalty on your overall invested value.
Cool. So I'll discuss this in little detail. Let's talk about exit load. It's not a sort of a taxes in that going to the government. It's is basically the purpose is to discourage you to take out money, right? So it is a sort of a penalty, and they want to encourage that you should do it for a long term. And they are usually in your amount invested. They are not on your profits. That is the important
Yeah,
concept over there that you need
in
to
what?
understand. In exit load, it's mostly on the amount that you invested, not on the profit that you might be earning. Yeah. Now, expense ratio is a little bit different. The expense ratio is used to cover the similarly kharcha bhani, the ongoing cost of the management fees, executive fee, building a kharcha ho raha hai, right? There might be different expenses, and they are taken regularly, not once. Now, this regularly can differ, but they are taken regularly. And these are some criteria that we need to check before investing in a mutual fund, right? If the exit load is high, then you need to make sure that your investment goal is long term. It's not very short term, and you don't keep it. You don't understand that money I can take out anytime, right? So, and when expense ratio is high, you need to understand if the expense ratio is high, is that mutual fund giving me enough returns so that I can cover up that expense ratio? Because your actual return is minus the expense ratio. Correct?
Yeah.
So
Himanshu,
now, yeah.
when will this exit load will be imposed on me? What
When
is
you will
the
take the money out, when you will redeem.
so no matter when I take it out, it will I'll always have to pay this amount of money, right? Or is there any case where, let's just say I'm taking out money after 5 years? In that case, it won't be, I don't have to pay
No,
that.
don't confuse it with ELSS. Let's forget about ELSS, that 5 year term. But yeah, over here it will be taken from. So if you take it out early, you need to make sure you put money, you stay for a longer time so that your profits can cover up your expense ratio.
Yeah.
Acha,
Yeah.
so this is something that I always have to pay. And if I'm in the market for long enough, my profits will kind of cover this.
So,
Okay,
Cover up.
got it.
just to add an example here, like if I talk in terms of, let's say, UC, the platform charge that we take is the expense ratio for running the servers, for running the CX cost, right? That is the money that we'll always take because that extra amount we need, even though we have take rates, even though we have our own profits, we still do expense ratio using convenience fee. And exit load is something like a cancellation fee where you're saying, hey, you promised something, but you're not doing it, then we need to we want you to not stop being so short term in decision making. So give us cancellation fee. It only is levied in certain scenarios when you do a early
No,
exit.
I might be wrong. I'll just reconfirm, but I think exit load is always taken, Manish. You can't say
Even
that.
if even after minimum years.
Yes, exit load is
That
always
is
taken.
Exit load is
Oh,
not that ELSS concept. We'll come to that later. It's like I have invested 100 rupees. I'll take 1 rupees out of this, your 100 rupees. So it's your responsibility to make sure you sell when you have earned 110 or 105 rupees. So that when the 1 rupees that goes, you have some percentage of return left. The reason is that they want you to invest for long term. They say, and they don't want you trade fund, right? If it was if the expense ratio was 0, right? Today you will start trading. आज खरीदा कल बेच दिया कल खरीदा short term, बहुत very short term market, and the concept of mutual fund is to stay away from that short term market.
Yeah, makes sense. Got it.
So Himanshu, one more question: are these two terms associated only with mutual funds, or are they part of stocks also?
No, not part of stocks.
Though
Stock
if you're
not,
doing intraday trading, you would need to pay the charge of, let's say, trading the asset.
but then you are paying that charge to the broker, right? You'll be paying to Zerodha if you're on Kite platform, right? Over here, this is mutual fund, so you'll be paying to fund manager. There is also something called a stamp duty that you pay to for buying mutual fund, but that we won't go over there, right?
Cool.
Cool. Yeah. So we understood this exit load, we understood expense ratio. Now, somebody of you said that we were investing in mutual fund because it was saving tax, right? Everybody wants to save income tax. Nobody wants to pay to government, and we have a provision of ATC in which you can save tax, right? So the concept over here that many people miss, the profit you earn on an ELS scheme, the equity linked saving scheme, is taxable. Okay, so it is not that I invested a money in a mutual fund that is ELSS and the profit I earn, the government won't take tax on it. Government will take tax on it. What is not taxable is that your income
Principal.
decreases by the amount that you have invested in an ELSS scheme. So the amount that you have invested, that is now not taxed in your income in that year, and it has a limit of 1.5 lakh.
But
Right.
Himanshu, that amount is like if the profit is above 1 lakh or so, that is some threshold is there, na?
That we'll discuss. So we'll have a session on discussing all the uh, rebates. It's a rebate that before 1 lakh you are not taking, but it's a rebate from government, but it is under your capital. It is calculated as a capital gain tax, but your total capital gain tax has some type of amount that you don't need to pay, right? Some threshold. Okay. It is calculated as a capital gain tax. It is not calculated as a capital gain tax, right? You don't need to pay it because that threshold is not met. Getting it?
Yes, yes.
So I think we'll have a session on how to read, like how to read the income tax and how to pay income tax on salary once. So this is what it is. Now another very concept, very cool thing, some is people the names, right? Mostly we see there is a name, something called a blue chip fund है यार ये तो किसी भी blue chip fund में लगा दो. You might have heard it, right? So what is this blue chip? किसी ने तो I am 100% sure everyone's portfolio here will have a blue chip fund. 90% I'm sure. Right. So basically the concept is blue chip. क्या? Exposure तो है.
एक फंड तो मेरा भी है, हाँ, blue chip में.
Yes, yeah. So basically, a large companies that are market leaders in their field, and we know they have a stable return for a long period of time, right? No matter how the companies, countries' economics, so they were doing good, not bad. Those companies are like blue chip companies, and there is a fund that is dedicated to invest money only. Like I won't take any risk. I will invest on these companies, so the risk is low. Yeah, that is basically blue chip. So now you understand most of the terminology. Let's say if you open any mutual fund, you will see all this terminology and you will be able to read all these terminology. But what will be the criteria of for you to decide, right? After reading all of this, but whether I should take this mutual fund or not, that is an important question. Like the practically you want to apply these learning, these definitions, right? Not only know these definitions, you need to understand what definition should be, what value should you want to do, right? So can anyone tell me, like, if anyone has taken a decision himself that whether I should buy this mutual fund or not, what have been his thoughts before that? Cool. I think I'll only start. So first of all, what I do is I try to find the fund manager. I need to know what is the fund manager, which company it is, what is its background, for how long it has been in market, right? You need to validate about the company. That is the basic thing. Forget about the rate of interest. Let's say there is a random company that comes to market and start giving promise of 30% rate of return, but that's so risky that it can go zero also, right? So first of all, you need to do a very good background check. What is the experience of the fund manager? What was his past funds he has managed? What type of returns he has given? What type of companies he tried to put money in, right? Whether he's a blue chip investor, whether he's a small cap investor, right? These are all criteria that you need to check. But after checking this also, you need to align it to your vision. What type of investor I am at, right? Am I a risky investor? Am I a long-term investor or am I a short-term investor? These first you need to find out what type of investor you are in your life, right? And the type of investor I feel like this is my personal thought, and maybe Anupam will align to it, that are in different stages of life, we are different type of investors, right? So
Himanshu, one follow-up question here. So when you say know your fund manager, are you talking about the house or the organization that is managing the fund, or the individual? For example, ICCI has various kinds of funds. So if I'm putting my money in any of those funds, so I need to know what kind of funds are managed by ICCI.
both, I would say both you should know.
Both.
That is very important for you. Let's say, have you heard a story where Franklin had some issues in COVID and there were many funds that needed to be closed by Franklin? Have you read about it?
No.
So it was not one
No.
fund, many funds got affected. So it's important to see both the fund manager as well as the top level company, right? So that is the first thing that I see. But now I see, does it align with my vision, right? What type of vision I have for me? I want to take money for 3 years. What type of goal? Is it a short-term goal? I'm investing money to buy a car, or it's a long-term goal. Investing money to buy a property, right? Or just a general saving. So that is your decision you need to make, and then you need to see these things. After that, you will find that similar funds like a blue chip, many companies are having blue chip fund, and many companies are good. HDFC is good, ICICI is good, everything is good, right? What else should I see, right? Fund managers also you like. Then you can go and see what is the past performance. But we need to remember the past performance is not the promise of future performance. Past performance will never be promise of what is the future uh, promise, right? But yeah, it's a good factor to see how it has been performing in different cycles, and they never see a 1 year horizon. 1 year horizon is not a good way to see. Always see multiple years of horizon, because you need to understand every country has a different economic status in different years and how it has performed to that economic, right, status. So that is very important. So see for a long term. Then you need to see these exit, load, and expense ratio, because these are also the part that will be taken up from your returns. So this is another thing that we need to see. So I have tried to capture it in 4 points. See the fund manager and the house. See the portfolio of the fund that you're investing in. Your investment objective and time frame. Risk diversification, fund size, and regular compliance. Like, see if everything is good. If this risk, you can take that risk. What is the type of risk that they are trying to take? And then you decide which mutual fund you want to buy. So that is the base of understanding a mutual fund and thinking which mutual fund to invest in.
So, Himanshu, I have a question. Should I ever purchase a fund, invest in a mutual fund, if its CAGR is less than the inflation or CPI?
See, if a CAGR is less than, now you need to see CAGR in long term. Don't see it in 1 year, right? It can be like in previous year it was more, but for a long term, if it is less, of course you should not invest, right?
Okay, but
But it
I
depends
cannot.
upon your risk appetite also, right? Let's give you an example. Let's say inflation is 8%. 8% inflation is very high. Okay, very high. 8% inflation. Now bank is giving you 5%, I'm assuming. Okay, and your mutual fund is giving you 6%. The mutual fund that you have told me, and it's very low risk mutual fund, very low risk. Now this 6%, I'm not talking for 1 year, I'm talking for 2-3 year horizon. If we have a 2-3 year horizon, now it will be your decision. Okay, it is giving me better than bank, and it's a short 6%, but it is giving me less than inflation. So is there any other way I could beat inflation? That is your thought. Over here, you are getting beat by inflation for 2%, but by keeping in bank, you are getting beat by 3%, right? So
Right.
you always want to check that also. If that is the only option, then you might go. But if there are better options available, surely want to go for a better option because you want. But you don't need to sit for a small horizon. You need to sit for a little long horizon, I would say.
Okay, okay. And this inflation ratio and CAGR both will increase over time, right? Or
No,
at least we are sure
you
about inflation, but not sure about CAGR.
no, inflation also decreases. You are not sure of inflation, right? If you see this table, I think I have not added it over here. I'll just show you some table that I have. If you see this table, right?
Hmm.
It was 3.9, it reduced to 3.7, it went to 6.6, it came back to 5.1, it went. So
Oh,
you cannot say that it will be ever increasing. This depends on multiple economic factors that maybe we can decide, we can discuss on that also one day with the interest of time, right? I would like, we can have some other session. But yeah, you cannot guarantee it, right? Your
sure.
government will try to keep inflation low, but it want to keep it too low also. There are some different reasons for that. Yeah. So
Yeah.
your aim is to earn maximum interest, but it also depends upon your risk appetite. You need to define your risk appetite. It should not happen that one day the complete economy collapse and you like not collapse, not in a good state, and you don't have money left with you, right?
Yeah.
So debt, when you have debt mutual fund provides you less rate of interest as compared to equity, but they are less risky, right? Because they are investing in bonds and T-bill, where you pay money to government and government has promised you to give you some return, and they will have to fulfill that promise.
So isn't that impacted by inflation?
It does. It does. So basically, let's say your rate of so it's a demand supply. Bonds are also demand supply game, right? So when they come, let's say Pakistan bond, right? Would you like to invest in bonds of Pakistan government right now? You know they won't be able to fulfill that bond, right? So you need to find that, and then rate of interest, you'll get the less the risk, the less the yield or rate of interest you'll get because it's a sure guarantee of the money. Mostly, this is the concept if you see at top level. But yeah, there are very different economic factors how bond yield and bond demand and supply change. Because let's say your bank rate interests go up, right? The demand of bonds in market will go low because you will try to keep in interest in your bank only. The supply will increase. You'll get it at a cheap price. Getting this concept?
Yeah, actually my internet got disconnected. So
Okay.
okay, I'll see the recording. Thoda sa, I missed a part of it.
Yeah, so we'll take that up also. It's a very good topic to discuss how bonds and inflation and how actually country's economy also related to it. Not company, you can say country and company, because company can also offer a bond and a country can also offer. Economics is same, right? Before thinking what to be the yield and everything.
Okay.
Himanshu, there is another term that I sometimes see in multiple platforms, that is XIRR.
Hmm.
So is it different from Kaggle, and
How is it
what?
different from Jagger,
Yeah.
right? So XIR, I think there are many invoice discounting platform also which have started using this, right?
Hmm.
So it is also a method, like in mutual fund also it is also a method to see like what is the rate of return, or it also has a different mathematical formula. I'm not sure about what is the mathematical formula, but XIRR is your personal rate of return, right? What I told you, this is the mutual fund interest over a time, how final amount and the previous amount. But XIRR is mostly what was your personal rate of return on your actual investment.
Okay, got it. Got it.
Because
So
your
it's
different
like,
transaction happen at different time, right? You
yeah,
don't every time
yeah,
invest 1st of January. You invest in different times, so the amount of return that you get is completely different.
got it. So it's like just like you pay in EMI. So it's calculated, interest is being calculated on each and every installment that you are paying. That is what XIRR is. Got it.
Except you can say, but exactly what it's trying to do is it trying to capture your inflow. Getting on your multiple inflows. CGR is not taking that into account. So when you do an SIP, right, you want to see an XIR, I would say. Because when you are investing after a regular interval, you want to see that what will happen to this, not the start and the end value. When you're doing a lump sum, CGR might be a very better factor for you to check.
Better. Got it.
Cool. I hope Vikas will now revisit his mutual funds today and see what he has invested in and what they actually mean.
Yeah, fine.
Hmm. Yeah. Any more notes that Anupam you would like to add here?
No.
No? Cool. Actually, expense ratio and exit are important. And you'll soon learn when you go in depth what to pick. We haven't suggested anything, because that
Yeah.
is not the goal of this track. We will not suggest anything or any stock. It is more about informative. That is the breadth of the things that we will cover in this track. But when we deep dive, and you personally deep dive, you learn something more about index funds, how to time mutual funds, all those things that you will learn. And there are mistakes that a person should avoid while buying mutual funds. I'll share that link in our group. I'll assume everybody of you should watch that link. There is much more depth to selecting mutual funds also.
Yes.
Cool. If we don't have any questions, I guess, thanks guys. Thanks for tuning in. See you next week. Take care. Cheers.
Bye bye.